The vast majority of market participants are driven by one singular overwhelming impulse, the avoidance of loss. Their strategy is one of defense dictated by the ever-present fear of being wrong. This leads them to snatch small profits prematurely, worried they will evaporate, while simultaneously clinging to losing trades in the desperate hope of a recovery. Yet, the path to accumulating significant wealth is not paved with the timid preservation of capital, but with the bold capitalization on correct judgments. The greatest fortunes are not built by being right a little bit many times over, but by being profoundly right on a few pivotal occasions. The most rational and paradoxically the most secure methodology for multiplying a small amount of capital into a substantial sum was a central pillar of Jesse Livermore's approach. This technique is known as pyramiding. It is not the impulsive speculation it is often portrayed as. It is a detached, methodical system of offensive market operations, a means to amplify the force of a correct decision and potentially transform a modest $1,000 position into a $100,000 one. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people, and tells me these deep dives are worth making. To grasp the constructive power of pyramiding, we must first analyze its destructive counterpart, which stands as the most frequent and disastrous error in the entire field of trading: the practice of averaging down a losing position. This is the great financial fallacy to which legions of traders, from novices to veterans, have succumbed. The sequence of events is all too common. An operator buys a stock at 50, assured of its potential. By the next day, it has fallen to 47. Compelled by what feels like a sensible impulse, he purchases another 100 shares, bringing his average cost down to 48.5. His rationalization is straightforward. If the stock was a worthy purchase at 50, it must be an even more attractive bargain at 47. He is not increasing his stake because the market has affirmed his judgment. He is increasing it because the market has contradicted him, and his ego cannot tolerate the implication that he was mistaken. He is, in Livermore's own phrasing, throwing good money after bad. Livermore regarded this habit with utter disdain, considering it the ultimate transgression in speculation. He wrote with piercing clarity, "Great numbers of people will buy a stock, let us say at 50, and 2 or 3 days later, if they can buy it at 47, they are seized with the urge to average down, having bought at 50 and being concerned over a 3-point loss on 100 shares. What rhyme or reason is there in adding another 100 shares and having the double worry when the price hits 44? The logic is undeniable. If the initial position was a source of anxiety, doubling down on that position in the face of mounting losses is an act of calculated financial demolition. The trader who averages down is not guided by evidence. He is guided by wishful thinking. He has replaced a concrete plan with a vague hope. He hopes the trend will reverse. He hopes his initial assessment will be validated. He hopes to escape his self-inflicted predicament. In a losing trade, hope is the speculator's most dangerous adversary. The psychology driving this blunder is embedded in our nature. First is the intense need to be proven correct. Accepting a loss is a direct acknowledgement of error, a blow to one's self-esteem. Averaging down is a mechanism to delay that admission, to tell oneself, I am not wrong merely early and now I'm acquiring my position at a superior price. Second is the fear of making a loss tangible. So long as a trade remains open, the deficit is merely on paper. The act of selling converts it into a real, concrete reduction of capital. The amateur will do almost anything to evade this moment of reckoning. Finally, there is the deceptive allure of a better average price. The arithmetic appears attractive, but it conceals a deep-seated fallacy. The operator is not strengthening his position. He is magnifying his exposure. He is compounding an initial error. Livermore was unequivocal. Never average losses. Let that thought be etched permanently into your mind. The only advice he ever took from a broker was a margin call. When you receive one, he advised, close out your account. You are on the wrong side of the market. Averaging down is simply preemptively issuing a margin call against oneself. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. Having established this unbreakable prohibition, Livermore constructed his entire offensive framework upon its direct opposite. The first principle of pyramiding, the bedrock rule from which the entire structure is built, is that one must only ever add to a position on a rising scale. He articulated it as a simple, inviolable law. Each subsequent purchase must be executed at a price higher than the one before it. This represents the intellectual and psychological nucleus of his method. Where averaging down is an expression of hope against contrary evidence, buying on a rising scale is an act of growing confidence, reinforced by positive market confirmation. Each new purchase is not a shot in the dark. It is a direct response to the market validating your initial assessment. The market itself is confirming that you are correct. The reasoning is straightforward yet profound. A speculator's function is not to bend the market to his will, but to align himself with its prevailing force. When a stock is in an uptrend, it is demonstrating that buying pressure exceeds selling pressure. The path of least resistance is upward. To buy in that context is to move with the prevailing current, not struggle against it. Every new high the stock achieves serves as additional proof of this underlying strength. Consequently, each additional purchase at a higher price is made with a greater degree of certainty than the previous one. The risk is not escalating. It is being systematically validated. Livermore did not view this as becoming more reckless. He saw it as the intelligent deployment of his reserves, committing more capital only as the evidence of a successful campaign accumulated. He outlined the mechanics with perfect precision. Imagine you intend to acquire 500 shares of a stock, he would explain. You begin by purchasing 100 shares. Then, if the market moves in your favor, you buy another 100 shares, and so on. This is not an arbitrary process. It is a systematic expansion of a position guided by market feedback. The operator is not placing one large wager based on his opinion. He is initiating a sequence of smaller conditional wagers, with each one dependent on the success of its predecessor. This transforms speculation from a single high-stakes event into a logical, evidence-driven campaign. The objective is not simply to have a position, but to have a position of significant size only when the market is moving decisively in your favor. The pyramid is erected on a foundation of verified strength, not on the shifting sands of hope. This leads directly to the second, equally vital principle of the pyramiding foundation. Your very first trade must demonstrate a profit. This is the gatekeeper for the entire strategy. If the initial foray fails this simple test, the pyramid is never constructed. Livermore learned this lesson through years of market observation and costly mistakes. Experience has proved to me, he wrote, that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. He eventually saw his first entry not as the beginning of his final position, but as a reconnaissance mission, a probe sent to gauge the market's immediate intentions. The purpose of this initial trade is to answer a single question. Is my timing correct? A speculator can possess the most insightful analysis of a company's fundamentals and the market's overall condition, but if his timing is flawed, he will lose money. The market itself is the sole arbiter of timing. Therefore, when Livermore initiated his first purchase, he demanded immediate validation in the form of a profit. If he bought a stock and it promptly began to decline, or simply went nowhere, he took it as an unequivocal signal from the market that his timing was off. "I was wrong," he would conclude. "It might be I was only temporarily wrong. But as I have said before, it does not pay to start wrong in anything." The proper response in this situation was not to wait, not to hope, and certainly not to buy more. The proper response was to exit the trade without hesitation, absorb the small predetermined loss, and step aside to reevaluate. This initial testing trade is the primary risk control mechanism of the entire pyramiding strategy. It ensures that all losses are kept small and contained, while only a position that is immediately proven correct is given the chance to grow. This two-part principle, making the initial trade a test and then pyramiding exclusively on strength, is a complete inversion of the average trader's mindset. The amateur looks for a bottom, hopes for a reversal, and compounds his mistakes by averaging down. The professional waits for confirmation, acts upon concrete evidence, and compounds his correct judgments by pyramiding up. This is the fundamental mental shift from a defensive, loss-focused approach to an offensive, profit-maximizing one. It is the recognition that the goal is not to dodge every loss, but to ensure that the winning trades are exponentially larger than the losing ones. Pyramiding is the mechanical engine designed to achieve this asymmetry. It is the vehicle that transforms a small, correct judgment into a massive, life-altering gain. This strategic approach of waiting for confirmation and then acting with force aligns seamlessly with the work of another market giant, Richard Wyckoff. While Livermore's method provides a blueprint for how to act once a trend is underway, Wyckoff's methodology offers a brilliant framework for identifying when that trend is most likely to begin. Wyckoff taught that major market moves are not random events. They are preceded by periods of careful preparation. His analysis of market cycles, particularly the transition from a sideways accumulation phase to a powerful trending markup phase, is the key to identifying the ideal territory for applying Livermore's pyramiding strategy. A speculator who merely tries to pyramid any stock that is rising might be doing so at the very tail end of its move. But a speculator who has learned to recognize the signs of a Wyckoфfian accumulation, the period where informed capital is quietly absorbing supply, can then unleash Livermore's tactics with explosive effect, right as the true markup begins. The foundational principles of pyramiding, to buy on an ascending scale and to cut any loss on the initial exploratory trade, demand a radical break from the instincts of the average market participant. They require a mental transition from a defensive posture of loss aversion to an offensive strategy of profit amplification. However, knowing the correct philosophy is only the beginning. To successfully build a $1,000 position into a $100,000 one requires a mastery of both the mechanics and the psychology of the process. An operator must know precisely when to launch his campaign, how to manage the risk of an expanding position, and how to develop the mental fortitude needed to carry that position through the inevitable volatility of a major market trend. Through decades of trial and error, Jesse Livermore refined these components into a cohesive and powerful system. The first and most vital element in the mechanics of a successful pyramid is timing. The decision of when to make that first commitment is paramount. An entry made too soon into a market not yet prepared to move will result in a small loss and a squandered opportunity. As Livermore's disastrous cotton trade so painfully illustrated, an entry made too late means missing the initial cushion of profit that is essential for providing the courage to hold a position through to its conclusion. Pyramiding cannot commence at just any point. It must begin at the precise moment the market signals its readiness for a major sustained move. Livermore's primary tool for identifying this moment was the pivotal point. He wrote, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." This was not speculation. It was the cornerstone of his timing strategy. A pivotal point in Livermore's system was a specific price level that held historical or psychological importance. Once this level was decisively surpassed, it signaled that the equilibrium between buyers and sellers had shifted, and the path of least resistance was now clearly defined. He identified several types of these critical junctures. The most common were major round number barriers, prices like 50, 100, 200, or 300. He frequently observed that after a stock crossed such a milestone for the first time, a rapid and sustained move almost always followed. His highly profitable trades in Anaconda, where he bought the stock as it crossed 100, 200, and 300, were textbook applications of this principle. Another type of pivotal point was a new all-time high for a stock that had been consolidating for an extended period. This breakout indicated that something fundamental had improved with the company and all prior overhead supply had been absorbed. Usually it is a safe play to buy the minute it touches a brand new high, he advised. Conversely, a stock breaking below a significant prior low was an equally potent pivotal point on the short side. The purpose of waiting for these points was to avoid the frustrating and capital-draining experience of being stuck in a directionless market. He would not commit his first exploratory share until the market itself delivered a clear and unambiguous starting signal. Once the pivotal point was breached and the initial exploratory position was taken and confirmed with a profit, the process of building the pyramid commenced. It is here that the myth of pyramiding as a form of reckless abandon must be dismantled. When executed properly, the Livermore method of pyramiding is a sophisticated form of risk management. The key insight is that the speculator's original capital is only at significant risk on the very first trade. Every subsequent addition to the position is financed by the existing paper profit. Livermore never used his initial capital to add to a position. He used the market's money. The profit from his earlier trade served as a buffer or a margin for his later ones. Let's illustrate this with a concrete example that follows his principles. A speculator with $1,000 of risk capital identifies a stock consolidating and establishes a pivotal point at $50. He waits. The stock becomes active and trades decisively through $50. He initiates his exploratory bet, buying 20 shares for a total of $1,000. His maximum risk is now set. He might place a stop-loss order at $48, limiting his potential loss to $40 plus commissions. The stock, however, behaves as anticipated and advances to $52. His initial trade now shows a profit of $40. He has been proven right. Now he makes his second purchase, buying another 20 shares at $52. His total position is 40 shares with an average cost of $51. The stock continues its advance to $54. His total position is now worth $2,160 against a total cost of $2,040, yielding a paper profit of $120. Notice what has occurred. He has doubled his exposure, but his original $1,000 is no longer in jeopardy. The $120 profit acts as a cushion. He can now move his stop-loss for the entire position up to his average cost of $51, ensuring that, at worst, he will break even on the campaign. His original risk capital has been secured. As the stock continues to rise, say to $57, his profit expands. He might then purchase a third lot of shares, again using his paper profits to finance the margin. The process continues, with the speculator adding to his line on a rising scale, and with each addition, moving his protective stop-loss up to safeguard his accumulated gains. The pyramid is built not by adding risk, but by compounding a correct judgment while systematically removing the risk to one's initial capital. This is the very antithesis of the reckless plunger's approach. It is a cold, calculated business method. Livermore did not simply hope a stock would rise. He demanded that it prove it to him every step of the way, and he only increased his commitment as that proof was delivered. The pyramid, therefore, is not a house of cards. It is a fortress built upon a foundation of confirmed market strength, with each new layer financed by the success of the one below it. With the mechanics of timing and risk management established, the final and most formidable challenge of pyramiding emerges. The psychological battle of holding a large, profitable position. It is one of the great paradoxes of speculation that it is often far more mentally taxing to hold a winning trade than to cut a losing one. The amateur is tormented by the fear of his paper profits vanishing. Every minor, normal retracement in the market feels like the beginning of the end. The urge to sell and secure the gain becomes nearly overwhelming. This is the fear that prevents a trader from capturing the truly massive trends, the moves that can turn a small account into a fortune. Jesse Livermore was intimately familiar with this internal conflict. "After attaining a goodly profit, you must have patience," he wrote. "But don't let patience create a frame of mind that ignores the danger signals." The key to this patience, he found, was directly tied to the very structure of the pyramid. The psychological fortitude required to sit tight is derived from the backlog of profit that a properly constructed pyramid provides. "I missed the backlog of profit," he said of his cotton failure, which is very necessary to provide the courage and patience to sit through a move until the end comes, and to stay through any minor reactions or rallies which were bound to occur. The speculator who has pyramided into a large position from a low initial entry point possesses a substantial buffer. When the stock has a natural pullback of a few points, he is not threatened. His position remains well in the black. He can observe the reaction dispassionately as a normal and healthy part of a larger trend. He can analyze its character, noting whether it occurs on light or heavy volume, and make a reasoned decision rather than a panicked one. But the speculator who entered late or has a high average cost with little profit experiences every dip as a direct assault on his capital. He is driven by fear, not by judgment, and is almost certain to be shaken out of his position at the worst possible moment. The profit generated by the pyramid is not just a financial asset. It is a psychological shield. It is the source of the courage needed to let a profit run. This is the essence of the Livermore method for transforming a small stake into a large one. It is a complete philosophy that begins with the humility of patience, waiting for the market to give its signal at the pivotal point. It proceeds with the logic of a scientist, testing the market with an initial probe and demanding confirmation before committing further. It builds with the strategy of a general, deploying more forces only on the ground of proven success, always protecting his base of original capital. And finally, it requires the fortitude of a stoic, the ability to sit with a winning position, to endure the normal ebbs and flows of the market, and to hold that position until the market itself, through a clear danger signal, announces that the great move has run its course. This is not gambling. It is not a search for easy riches. It is the application of sound business principles to the art of speculation. It is a method that demands discipline, study, and an unwavering respect for the market's supreme authority. It is, when mastered, the most logical path from $1,000 to $100,000.